Samuel, let's pick up on the shilling and commentary from the acting finance minister regarding the levels that the ministry is comfortable with right now. We've seen the shilling retreat from below 83, where it was trading at yesterday. It closed above this level. But of course, the question now is, with the shilling sitting at around 82, is it likely that we might see interest rates being cut sooner than expected, given the fact that the finance ministry has said they're now comfortable with where the exchange rate is?
Well, I do think so, and then considering the fact that inflation has also come down, I think we could be expecting that with the CBR meeting very soon, then we would probably either see a slight decline in the interest rates. I don't think that they're going to be in a rush to, really do major cuts. They would rather probably take it gradually and see how the shilling and also the economy reacts in the medium term, rather than go for drastic cuts.
So on that basis, when are you looking at any cuts in the interest rate? Key lending rate right now, which we know is sitting above inflation at this point in time, with inflation coming in at 16.69% year on year. That's the latest inflation figure.
Yes, we do. We are all looking at that, and but we could be in for a surprise. We are still. I think this is the third month running where we've seen inflation going down, but I still think that we still needed to go down further. There is still a bit of uncertainty on the fact that we have heard that fuel or wild oil prices have actually spiked, and we also haven't started seeing the rains. The long rains haven't yet picked up, and that could also be a negative for inflation. So they will be looking at all the factors and looking at whether they feel that maybe inflation could rise in the next few months, or we could see a continued drop based on what the underlying uncertainties are.
In the meantime, earnings season, of course, is firmly underway, and we've had some trading updates as well from companies. CFC Insurance shares really reacting well to the news that they're looking at a doubling of profit before tax. They made a profit of around 482 million shillings in 2010, and they're expecting it to be at least 800 million shillings. What do you anticipate has driven this strong performance for the year?
Well, I think that the insurance sector in Kenya has been in a transformation period. We have seen, for example, in the last 1 year, we did see CFC separate their businesses from CFC Insurance and CFC Stanbic, the financial services side of it. And we also saw British American come to the market, and we are also starting to see a higher insurance uptake in the region, especially with insurers now beginning to take more risk and taking up things like political cover, etc. And so I think the insurance sector is in a growth phase, and I believe that that is now beginning to be reflected in their bottom lines.
So good, really fundamentally, from growth in its insurance book and underwriting operations. But what about its exposure to the equity market and to the fixed income market? Because we still need to take that into account. And we've seen how the valuations of government bonds have hit other insurance companies.
Well, I think that that would definitely take a toll in terms of the valuation of government securities. Exposure to the market, I believe that after the announcement, we did see the share price spike up, which means investors are quite happy with that prediction, and so they'll be looking forward to see what the actual figures are. Of course, that was just a preemptive announcement, and so we're still waiting to see what the actual figures are. But anyway, having doubled, that is an excellent, pointer towards or an excellent signal to shareholders who will be feeling that the return on equity is healthy, and they would be feeling that it would be a share to take positions on, which I think is what they're doing.
Let's move on to the oil sector. We saw KenolKobil reporting some really strong results as expected yesterday, a 71% increase there in profit before tax. How sustainable are these kind of earnings for the company, especially as it has strong capital plans in terms of capital investment plans in the region?
Well, what we have seen is that a lot of multinationals have left our market basically because they feel that the capacity of consumption within our markets is quite low, and KenolKobil has leveraged on this to spur a huge expansion theme, which has really worked for them. Considering the fact that KenolKobil and Total Kenya are actually the biggest competitors in that sector, of course we have a lot of private fuel distributors in the country. You'll find that Total gave, I think, a profit warning, and they've had a lot of legal issues, while KenolKobil has increased their storage capacity, they've increased their distribution network, they've been going regional, and I think that if by any chance, you know, any more multinationals leave the market, then KenolKobil will end up being the dominating petroleum distributor in the country and probably in the region, which is, I believe, what KenolKobil is really leveraging on. And they did have a discounted price on all the fuel prices that, in as much as fuel prices were controlled, they were giving discounts, and they still made quite a huge profit gain, which means without the discounts, they would still have a very big margin in which to play with their bottom line.
Very quickly, Samuel, Centum is looking to build a 60 billion shilling mixed retail estate property in Runda, of course looking to get into the lucrative property market right now. This will be the largest single investment in Kenya, so really significant for the country, but of course significant for Centum. What type of reaction are we going to get from the market to that news?
Well, they have talked about the investment in Uganda, and I haven't read about, I think, did you say Rwanda?
In Runda.
I haven't read about that, but I'll look at it. But I believe that Centum, it's usually valued on net asset value, and so the issue is where they're going to raise the funds from. Do they have enough funds to actually do the investment? And once we know where they're going to raise the funds from and what sort of future, the present value of growth opportunities that they're actually you know, providing, or we actually see within the projects that they're undertaking, will really inform how the market values that. So I believe there'll be a bit of a lag before the market actually reacts to the announcement of an investment, maybe in the next 1 or 2 months before we actually see where we expect the value of the stock to go.